Hi everyone, good evening. Today is the 25th of June 2024 and today we'll bring to you another very interesting business analysis. Today we will look at Techno Electric and Engineering Company Limited. This was again referred to me by Ratan. Thank you so much Ratan for bringing such interesting businesses to my notice. I love analyzing them. In this particular video, we will analyze the business in three separate sections. The first one will be the overall business model of the company. The second one will be a quick financial analysis of the company. And third and the most interesting one will be the part wherein there were a few, mismatches which I saw between what the management is saying and what the numbers tell me, which I will present to you for your consideration. Do watch the video till the very end. Do like and subscribe to our content. We do bring such interesting analysis very frequently. And yes, let's quickly get into it. So as a business, Techno Electric and Engineering Company Limited is basically in the EPC space but focused on the power transmission and distribution segment. Its primary business segment is the EPC part, wherein it provides fuel gas desulfurization turnkey solutions to power plants. For transmission activities, it makes substations, both air insulated and gas insulated. And as an extension of this business, it recently signed a PPP with Haryana government to lay down a transmission network and then earn revenues out of it, just like you do on road, depending on the load carried through the network. It had a wind energy part to it, which I believe is now sold, wherein it used to produce about 130 megawatt of wind energy. So its primary business still remains the EPC and the transmission division. The order book of the company is a healthy 9,000 crores compared to a 2024 sales of 1,500 crores, roughly 6 times 2024 sales. But again, all its projects are long gestation projects. So I'm assuming this 9,500 crore will translate into sales over the next 4 to 5 years, essentially giving me an annualized revenue of anywhere between 2,000 and 2,500 crores. The company is now diversifying into the data center business, wherein it is getting into creating ultra scalable hyper density data centers. The first such data center is being set up in Chennai, which has a 40 megawatt of grid load and 20 megawatt of IT load. The second center is under execution at Kolkata with 24 megawatt IT load. In the long term, it wants to do about 250 megawatt of data centers across the country. And what exactly is data center? This data center is nothing but a physical space wherein it will provide you the larger building where the data centers can be located. A cloud computing company, a large corporate which wants to keep its data center off grid, off site, can keep it there at its location. So my understanding, and I may be wrong, and you as a viewer please correct me, Techno Electric is essentially wanting to rent out space in the data center business, and it essentially remains a renting operation. It is not getting into cloud computing or cloud service provider, space provider as an E2E network, but it will become the space provider wherein the hardware will be located. E2E network will maybe take this data center on rent, is the larger model. That is the growth plan which the company has identified. With that out of the way, let's quickly get into financials. (2024) sales were 1,500 crores with a profit after tax of 271 crores, a 15% kind of number. The operating profit margin for the company remains about 14%. ROE remains a very average 13% and ROC at 16%. The market cap of the company today is 16,000 crores. To put it in perspective, its order book today is 9,000 crores. So it is actually discounting the entire order book and order book which it is yet to receive. It's probably, discounting growth for the next 7 to 8 years into today's price. The stock P is at a rich premium of 61.7 times compared to an industry P of 37 times. Similarly, the price to book value is again at a premium to the industry at 7.75 times compared to industry price to book value of close to 4.5 times. The valuations look premium. The returns on equity and return on capital employed are average to middling at best. What worries me here is the very, very high working capital days of 420 days in 2024. But even if we consider that as an aberration, historically also the working capital days have been close to 300 days. So that compared with a very, very low ROCE means no matter how fast the business grows, its profit will remain average at best. To put things in further perspective, let's assume the company will do a 2,500 crore turnover in 2024-25, which is an incremental 1,000 crore turnover. For that, it will have to pump in a 600 crore as working capital just to get to that number. Now, does it have 600 crore in its books today? On a 2,500 crore turnover, it will make close to a 325 crore as profits, which it will pump in, of course. Still, it has to, plug a gap of 275 odd crores. That has to be plugged either through borrowing or through utilizing the reserves and the cash balances which it has. And you know what? This is just the working capital need. What's more, the company has a planned outlay of 2,000 to 2,500 crores annually going forward. Where will that money come from? Obviously, the company has to either borrow that money from the banks or it has to issue fresh equity and dilute further. Both of which I as a shareholder don't like. If you borrow money, you pay interest and my returns get depressed. If you again issue further equity, right, my earning per share goes down and my holding in the company, my returns as an investor are again diluted. So either ways, to reach that level of growth, whether it borrows or whether it issues equity, I have a problem as an investor. Today, it of course is sitting at zero debt, but if it wants to invest 2,000 to 2,500 crore annually, it can't remain at zero debt for a very long time. It has to go and then borrow. This is as far as the quick financial analysis goes. Richly priced compared to its peers. A lot of growth is already factored in, at least for the next 5 to 7 years. Margins are average at best, and for any kind of growth, it has to do a lot of capex and a lot of opex and working capital infusion, both of will entail either further borrowing or further issue of capital. So that's in a nutshell what the business is all about. So this is as far as the financials go. As promised earlier, when I was reading through the numbers, through the data, I came across a few very, very interesting things wherein the management is saying one thing and then management is contradicting itself through either the numbers which they are quoting or through another statement which they are making. Let's start with the capex part initially. In the 2024 earning transcript con call which the management had, it said that the capex planned over the next 4 to 5 years is 25,000 crores. Now to put things in perspective, its whole order book for the next today is 9,000 crores. It plans to do a capex of 25,000 crores, primarily in data centers and primarily in smart meters. Where will that money come from? Assuming the returns remain the same, the 9,000 crore order book will give them a return of close to 1,700 crores. 13-15% return, 9,000 crore order book. In addition to that, a data center will yield further 13-14%. So that also incremental revenue will come into the play. So assuming another 5,000 crore coming in from data center revenues over the next 6-7 years, it still means that it has to borrow at least 15,000 crore. It will not be able to generate more than 10,000 crore of internal accruals. A 15,000 crore borrowing on a 4 to 5,000 annual revenue run rate, that is what the company is expected to reach, is again a not so happy proposition. If it does not want to borrow, then it has to obviously issue equity, which again will dilute me as an investor. So again, not a very happy proposition. Now that is the one part of it, wherein the company is saying capex planned over the next 4-5 years is 2,500 crores. In another part of the earnings con call, the company said that the capex expectations annually remain 2,000 to 2,500 crores. Now my whole question to you, the management, is which one is it? A 2,000 crore annual capex is 10,000 crore investment in next 5 years versus you're saying 25,000 crore at another place. Don't you have your business plans clearly laid out, Mr. Management, for the company? Come on, let's be clear about the numbers, right? At least the plans which you are. It can't be so, off the cuff. Secondly, another thing which they said, and it really made me think. At one of the places, their statement was cash is king and it assures us of timely supplier payments. Now is 180-day payment cycle timely supplier payment, Mr. Management? Even the law says that you have to pay the SME companies within a span of 45 days. And you are paying them in 180 days. At least be consistent with what you're saying and what you're doing. So, in a nutshell, I'm not sure what the management is trying to project. Management was not very, very clear about what kind of margins the data center will accrue. When it was specifically even asked by one of the analysts, the management said that the existing margins will be maintained. Now, that doesn't really give me confidence in that we should even, go towards that side as a business model if it will retain a 12-13% kind of margin. But yes, overall very richly priced from whatever angle you want to see. Margins which will remain average at best, and the fact that the probability of either the margin is being diluted due to debt raising expected, or me being diluted simply because there will be more equity issued remains. So for me, this is at this point a miss. Maybe at a better valuation, at a better clarity from management, I will look at it. But at this point, it's a miss. And yes, with that, we will come to an end of this video. And until next time, happy investing.